American business is in crisis. The businesses that employ half of this country's workforce are up against the ropes. Hundreds of thousands have requested help from the government. The success rate remains up in the air. Tonight, 4 American business owners tell us their stories as we try and help them on their path forward. This CNBC special report begins right now. Here's Sarah Eisen.
Good evening, everyone. We are here tonight to help American business owners get back on their feet after what can only be described as a terrible 3 months. We'll speak with several owners this half hour. To help us through it, we are joined this evening by Alicia Syrett of Pantegrion Capital, an investor in dozens of businesses. Alicia, good to see you. What are things like right now for the businesses you're working with?
You know what, Sarah, I'm hearing the same consistent things across the board, and that is things are very tough. Obviously, there's a huge focus on costs right now, cutting costs, and unfortunately, layoffs. People are desperate to secure capital, hence all of the talk around the importance of getting PPP sorted out. There's a huge focus on health and safety like never before. And I think businesses are very hesitant to start up again as we go into this new environment. And this is consistent.
Let's bring in our first business owner tonight. Dara Pickett is the owner of Mezzaluna Day Spa in New Jersey, a state that is still closed. Dara, thank you for joining us this evening. What's happening with your workers and with your financials as you wait for any word that New Jersey could reopen?
So, hello, thank you for this opportunity. And yes, so we've been closed since the week of the 17th, as per the governor's orders. So I have 14 employees who are now laid off. And I just recently received the PPP funds. However, I'm in a difficult situation with that. I only have 2 people so far that haven't received unemployment yet. So they're the only ones that I'm currently paying through that. Everybody else has their unemployment, and they've also received unemployment bonus, which is more than what they make. So they don't want to give that up. Especially with the uncertainty is that I only have enough funds were given to me to pay for 8 weeks, and we've just had another month extension on being closed down. So I don't even see anything soon coming our way that we will be opening.
Dara, hi, it's Alicia. It's nice to meet you. Thank you so much for sharing your story. And what really touches me about your story is that you are the quintessential local business that we should all care so deeply about and be supporting. I read that you were the best massage in Bergen County. I only wish I knew you before all of this mess. One of the things I really want to focus on, and I will tell you, I think not many people are able to kind of predict what's going to happen with PPP. So I'd really like to focus on all the great things that you're doing to adapt in this environment. As I understand it, I think that you have been live streaming yoga on Zoom, and you've also set up curbside pickup to deliver gift certificates and retail products. Talk to us a little bit about all the ways that you're adapting to make things better.
So just like you said, I have been doing some Zoom yoga classes, also retailing some products. We do have Mother's Day coming up. This was one of our biggest spa holidays other than Christmas. So this weekend, we are selling gift certificates. People have been calling in and, again, asking when we're going to open. People can't wait to book an appointment. I feel a lot of people are 50-50. Some people can't wait to come out and some people are going to be nervous. So it's definitely a different holiday than what we're used to. But like I said, we do have people coming in to buy gift certificates. I have a little shop here that we sell products, candles, CBD oils, incense, and aromatherapy. So people are asking for those things.
they need you to distress them when this is all over.
Yes, but all of these like retail items and things that I'm doing where I'm fortunate that I have a way to stay in contact with our clients, it's really not enough. You know, it's not going to cut it. Paying rent, paying my bills at home. Like when I'm working, things are well. Like clients coming into the spa is really what our business is. So, you know, just like hair salons and yoga studios and gyms, you need the people in there. And I feel that we, at this point, just knowing friends of mine that have businesses like I do, hair salons and yoga studios, we're all like eager to get back to work. We understand what's going on in this society, and we're all ready to adapt and do what we have to do, you know, to open up and work. So,
right, Dara, just wanted to follow up on one thing you said about your workers, because this is something we've heard, and I just want to explore this a little bit. Are you sure that they are making more on unemployment benefits and therefore don't want to come back for that? And is there anything you can do? Can you pay them more or give them some sort of incentive to get them back to work when you're allowed to do so by the state?
So here's the thing. I'm sure when their unemployment runs out, because with their unemployment, they got this extra $600 bonus. So where a lot of them, that might be what they usually made because, as you know, in spas and in hair salons, it's a big tipping industry. But I don't pay them their tips, the clients do. So where I can give them what they got on their payroll for the hours that they work and the clients that they saw, you know, it's just a difficult situation. Now some of them are bringing home $1,000 a week and they don't have to leave the house. So that was kind of another CARES Act for people who are on unemployment. But with the money that I received, I can't afford to pay them all that. So when we do open back up, I am willing to have them all come back. And again, I don't know at what scale that'll be, but the therapists who have been here, they've all been here a long time. They have their clientele who would love to see them again. So they will all have work, but they're not willing to come off of unemployment at this moment because of the bonuses that they're getting on unemployment. So it puts me in a difficult situation. I guess what I receive is going to turn into a loan for me.
Dara Pickett, we wish you the best of luck as you make it through this terrible period. Thank you. Of Mezzaluna Day Spa. Special events have been called off across the nation. Nobody knows better than our next guest, Stephen Tansman, president and CEO of Yacht Events in New York. He's lost all bookings and nobody knows when New York will reopen. Stephen, welcome. Thanks for coming on. I mean, we must be heading into what is your prime season. How are you managing?
Hey, Sarah, Alicia, thank you so much for hosting it. Yeah, we're devastated in our industry, and particularly because we're seasonal. Our season is April through October. I mean, we literally were hit at the worst time, you know. Our prom, graduation, wedding season have all either canceled, postponed for next year. The same with our trade shows, our corporate clients. We employ thousands of workers, wait staff, bartenders, culinary staff, marine crew. We purchase tens of millions in food and beverage every year, and all of which is completely shut down. Question is, you know, how do we pivot and create a path forward?
Stephen, thank you so much for sharing your story. I understand you are one of the top event producers in New York City, so I think we're all pulling for you on this one. You mentioned pivoting, and one of the things I'm seeing from a lot of businesses is how they're changing their marketing and their messaging and the different services they offer. going into this new environment. And I wanted to talk about your situation. So do you see a different marketing message going forward? You know, I think of sailing and I think of the fresh air and freedom. That sounds really appealing to a lot of people in apartments right now. And also, I think, correct me if I'm wrong, you've also thought ahead about maybe giving kids back their prom that they missed out on, or doing something for the first responders and nurses that have given so much through all of this. How are you thinking about new messaging and potential services in the future?
Yeah, so, you know, we're uniquely positioned in the hospitality industry. The largest percentage of business is private events, but we provide tour and travel, transportation services as well. So, you know, we are open and believe, you know, our guests will much prefer cocktailing, dining al fresco, and open air decks and rooftop lounges rather than being confined in crowded bars or restaurants. Not to mention, you know, breathing fresh air, as you said, and all with incredible views, you know. Although, you know, we need to adjust as an industry. We're profitable. It's not as profitable in private events, but open public, happy hours, sunset, moonlight cruises may be the path for us this season, you know. Question is, when will we be open and under what restrictions? But, yeah, you know, we're planning on, you know, we'd like to have grand openings, you know, when they let us open up. We're planning a flotilla for proms and graduations for, you know, 2020 class. It's terrible. These kids have purchased dresses and, you know, they're never going to get this back. It's a once in a lifetime, you know, memory. And so if we can get back, we want to create something maybe with some sponsorship, but get these kids out, you know, for a memorable evening. First responders, we absolutely want to get them on board, and we're going to do that as individual yacht producers and get them out on a night that they so deserve. But we need to pivot.
Stephen, are you also seeing demand that you maybe hadn't before from weddings? Maybe people who didn't, you know, who don't want to have it in a confined event going forward, and then they want to book a future date with you now. How does that look for you?
Yeah, most definitely. You know, it's funny because the cancellations or postponements at other venues, we are getting some calls from wedding clients who are looking for available dates. And it is something that, you know, they're looking for something different and a change. Maybe they were in a different, off-site or different location, and they're looking to be in New York. And we can create such a different, you know, atmosphere of indoor, outdoor design menus that are more cocktail style, freer flowing. So social distancing, you know, might be a part of that, and rather than your traditional, you know, dining gala experience. So we're adjusting as event planners. That's what we do. You know, we get thrown curveballs all the time, and we change with the environment. And so we will, you know, be reaching out. We think we have this incredible venue to offer, as we said, open air, rooftop lounges, dining al fresco, cocktailing. We just might not do it, you know, with all events.
Well, it sounds wonderful, Stephen Tansman. Thank you for joining us tonight of Yacht Events. And for more on how businesses around the country are navigating the coronavirus outbreak, go to cnbc.com/smallbusiness. Tonight, North Carolina is greenlighting some businesses to reopen. Ryan Hoover joins us now from Charlotte, where he owns Fit to Fight training centers. Unfortunately, his self-defense, martial arts, and fitness classes are not allowed to resume just yet, and he's fighting to keep his businesses alive. Thank you for joining us. How and when do you think about reopening your stores and your sites?
It depends. I think about opening often. Whether North Carolina follows suit is a different story. We're being told a minimum of 2 to 3 more weeks.
And then what does that look like when you actually do reopen? How do you plan?
Well, that's the real problem because we don't know. They have given us very little, if any, information in regards to what that will look like. It's basically, well, you're going to have to maintain social distancing guidelines. Well, that varies a lot, and with what we do, it's not really incredibly conducive to operating normally. So we'll have to go heavier on the fitness side for sure.
Ryan, it's Alicia here. And first, thank you for sharing your story. I read about you, and there were a lot of things that were nothing short of inspirational in terms of the services you provide to veterans with PTSD or domestic abuse survivors, teaching them your craft. I think it's pretty amazing. And I'm glad we're focusing on fitness as a business because of the importance of de-stressing and building immunity. There is a lot of uncertainty in this environment, but I understand that you have kind of seen the silver lining. And is it true that you went into launching live stream classes right away? And are you now offering more products online? Give us a sense of some of the positive things that you've done in this environment.
Yeah, I think after I allowed myself maybe 10 minutes of, well, this is terrible, we immediately decided, okay, well, we have an awesome member base. We have awesome students. We want to continue to work with them and keep them engaged and keep them doing something because it's stressful for everybody. Everybody is, our tagline here is everyone's fighting something, and it's incredibly true. And so we immediately decided, okay, well, let's figure out how we can do what we do online. And we produce a lot of video content already. But, it's one thing to try to reach people in their homes when maybe they have a partner, maybe they don't have a partner. And, it's a new way of doing it for us as well. So it was a challenge for sure. We've been incredibly fortunate that our members have been super supportive, though.
It sounds like it. And tell me a little bit about the new types of programs that you're offering that incorporate the social distancing. Yeah,
so when we get to reopen, our first phase of reopen, we're adding new fitness programming that will allow us to kind of mimic a lot of the moves and movements that we're doing in some of our martial arts classes. But, it will allow you to do kind of solo without having to have contact. We hope to still be able to run the Zoom classes for people that want to do that with partners that they feel comfortable working with. But, I don't think that North Carolina is going to allow us to get back to normal right from the jump.
Ryan Hoover, we hope you can open soon, those gyms. Thank you for joining us with your story tonight.
Appreciate it.
Our sister network, Telemundo, is partnering with the U.S. Hispanic Chamber of Commerce to launch Our Businesses to provide resources and guidance to small and medium-sized Hispanic-owned businesses hit by this crisis. For more, you can go to telemundo.com. Phase 2 reopening. Texas went into effect today. This includes salons and swimming pools. Blair Smith, our next guest, owns Dirty Dog. It's a dog grooming and boarding business in Austin. She was allowed to open during phase 1 this week with a few adjustments. Blair, welcome. Thank you for joining us tonight. What was it like to reopen?
Well, it's been a little bit chaotic. We've had, April traditionally is our biggest month, our busiest month when it gets warm here in town. Everybody needs their dog groomed. So missing that whole month, trying to get everybody scheduled has been a little bit of a challenge, but it's, we're happy to have business.
I read a little bit about you and saw that you were rated the best groomer in Austin, and also that you had a GoFundMe campaign where your clients really stepped up to support you in this time. And so I think it speaks to, how much you care about your customers and the dogs. So I wanted to understand a little bit about how you're changing your offering for the customers going forward, to take into account social distancing. Is it no walk-ins anymore, only appointments? Are you doing curbside drop-off for the dogs? How are you making people feel comfortable now that you're reopening?
We have done a couple of different things. One is, yes, curbside drop-off. We're not having any customers come in the house right now. I'm in the shops. And we also added a new service. Half of our business is self-serve dog wash, where people come in and wash their own dogs. That's not open yet. And so we have added a express room. And so people express baths, so that we're trying to replace the self-serve business.
And are you also thinking about opportunities in the future around selling merchandise or maybe doing online videos to continue to educate your customers?
We've been talking about that. We've been so busy, trying to navigate all the systems that we're learning with the video stuff. And then we're probably going to start carrying some inventory, maybe some dog food, things like that.
And that would be to be an essential business?
Yeah, just another source of income, another revenue stream.
Blair, thank you for joining us tonight. Good luck as you handle all of that demand.
Thank you very much.
Dogs that were cooped up.
American investors have lost vast amounts of wealth. The crisis has left no household untouched. For the millions of Americans who have saved and invested, they found out there are no guarantees. But there are ways to protect your money, to plan and invest for the future. Tonight, a special report dedicated to answering your questions. The path forward, your money, begins right now. Once again, here's Sarah Eisen.
Good evening, everyone. We are here tonight to try and help our viewers find a path forward through this very difficult time for anyone managing money. While stocks have made quite a comeback from their lows, there's still a lot of uncertainty. We're ready tonight to take your questions. Josh Brown is the CEO of Ritholtz Wealth Management. He's a CNBC contributor. Also with us tonight, financial advisor Nina O'Neill of Archer Investment Management. Josh, just first want to quickly ask you what you're hearing right now from your clients in the middle of all of this uncertainty.
So, Sarah, I actually think you hit it right on the head. The stock market rebound doesn't do anything to dispel the uncertainty. And in a paradoxical way, it actually introduces more uncertainty. People look at what the S&P 500 and the NASDAQ have done, and it doesn't square with the reality that they're currently living in and talking with their friends and neighbors and customers and so forth. So I think that is actually the moment now that we're in, where everyone has to say to themselves, okay, I have no control over what the markets are doing from day to day, hour to hour, but there are some things that are in my control, and that's what tonight is all about. So really appreciate having my friend Nina O'Neill here. Nina is a rock star financial advisor based out of Raleigh, North Carolina. Sarah, why don't you let us know what the first question we got from Craig Hodgins was?
Yes, so we are going to hear from Craig Hodgins, and he submitted it himself. Let's listen.
With the high levels of borrowing the U.S. government is going through, how should a young investor position themselves to hedge against these high debt levels and the possible run-up in inflation?
Josh?
Yeah, so I think that's a question that a lot of people are wondering. They see the numbers, $1 trillion rescue for this, another $1 trillion for that. Eventually, all these trillions will add up. But the truth is, there really isn't an established link between government indebtedness and inflation. I know a lot of people think there should be, but look at the last 25 years. The federal government has rapidly increased its spending, and all that's happened is a consumer inflation price that's below 3% for all of that 25-year period. So that's not to say there won't be inflation in the future. Our answer to clients that ask us about that question is that we think stocks and real estate offer a superior long-term inflation hedge relative to other options out there like gold. And the reason why, very intuitive, businesses can raise prices in a time of rising prices. Real estate companies can raise rents. So if that's your big worry right now, is that all of a sudden there's going to be this explosion in inflation, I would say it's the opposite of the world's expectation based on bond prices, but there is an answer for a long-term portfolio. Nina, how do you answer this question when people come to you with it?
Well, I think it really comes down to, if you're a young investor, I'm not sure that that's the worry that should be front of mind. I mean, really the thing is, back to financial planning, it's watching your cash flow, watching your own debt, and investing over time and taking the opportunity now while you're young to start that drop in the bucket, and not really worrying about some of the big picture things that are going to be completely out of your control much down the road.
So let's get into this next question from Lance H. He asks, here's a question that can help the audience from my 20 years of investing. Position sizing. What's your advice on how to properly calculate your position size for both a trader and an investor? Well, we'll leave the trader part for another program. But Nina, this sounds like concentration risk issue to me. What would you say to that question? The right position size for each holding for an investor?
Yeah, I mean, I think when you look at position size, it's really not an issue until you get into a more concentrated position. So maybe something's 15+% over what it needs to be in your portfolio. So for example, we see a lot of things with people that have been given company stock or bought into ESPP programs, and then over time they realize that they have a very serious concentrated stock position and they need to move out of it because they have too much risk in that one bucket. I also think that when you work with an employer and they're compensating you in that way within your 401k plan or your ESPP plan, it can easily be something that's an added risk because you have your annual income based on that company and then some of your short and long-term savings. So we like for people to be mindful of, yes, utilize some of those programs, but don't get so many positions where you're over allocated to one company or even one area of just the asset classes in general, maybe real estate, as you just mentioned.
Yeah, I think that's a really good point. The only thing I would add on to that is it works both ways. So if you've had an oversized position, a concentrated position in, for example, Amazon for the last 10 years, you're saying to yourself, what risk? This is working out great. But right. I think it's important that you introduce that person to someone who's had a concentrated position in, for example, General Electric. Very different experience. And I think we all have to understand it's very tough to decide which is which beforehand. It's easy to know afterward which one you want to be concentrated in. Let's get into this bond question from Ann McDonough. Why do bond prices go up when their yields go down and vice versa? What are your thoughts if someone my age, 65, is invested 100% in equities? I don't have much of a time horizon to invest, but why not? Nina, what would you say to Ann?
Well, I like to mention that bond markets have risk too. So it's not necessarily that because you're in bonds or fixed income that you're not taking on any risk. I think it comes down to the individual's personal risk tolerance and what they're okay with if they're okay with 100% equity exposure, then I think that's perfectly fine. It's really, I think, more of a where's your comfort level with investing, and are those equities appropriate for where you are in your time horizon and what you're comfortable with seeing your portfolio potentially fluctuate.
Yeah, I think it's important is to think about, why are you buying bonds in the first place? And I think, Ann, let me tell you one happy piece of news. The actuaries tell us that if you make it to 65 as a woman in America today, you have a 1 in 4 shot of making it to 95. So don't be so sure that you don't have much of a time horizon. You could conceivably be looking at 30 years from right now, and that really wouldn't be out of the ordinary. So equities are your friend in that scenario. Equities are going to help you preserve your purchasing power much better than bonds will, given where yields are today. But here's the thing. In order to get that reward, you're taking a lot of risk. A bad day for the bond market, a bad day for the stock market is like a bad day for bonds. So standard deviation for stocks is almost 4 times higher. You're going to have to endure a lot more volatility with that portfolio. I want to get into this question from Drew Pratt.
Sorry.
Yeah. I want to get into this question from Drew Pratt, Nina, from San Francisco, because he's asking what are the key takeaways for older investors during the coronavirus-related turmoil? Did this simply reinforce some of the key tenets of planning and investing, or possibly introduce some new best practices? What are you seeing with your clientele, especially investors who are on the older side?
Yeah, well, I think the coronavirus pandemic economic disaster has certainly reinforced financial planning and the fundamentals there that every individual household and business needs to make sure that they're shored up with cash and have found that foundation and have really looked at their financial situation. But the CARES Act has introduced some new planning opportunities. So, for example, just to touch on a couple of things, required minimum distributions for qualified accounts are no longer required for 2020. So investors that don't want to take those distributions do not have to for this year. Also, there's some tax relief for people that need to take out larger distributions from their IRAs. So I think it does introduce some planning tools, but really implemented the foundations, or emphasized that the foundations of financial planning are here and alive and well and need to be continued to be addressed.
I think that's a really great point. A 60-40 mix of stocks and bonds does not look catastrophic now, nor did it even at the bottom of the market on March 23rd. So that's kind of an old school tenet of financial planning that has actually helped people. Sarah, back to you.
No, I just wanted to ask you guys, I mean, nobody's ever seen anything like this, Josh. So how much of the patterns and the historical strategies can you really rely on versus ripping up the playbook and starting from scratch, a pandemic, an economy that has been shut down globally? I mean, these are such huge questions that people just don't have answers to.
Well, I'll give you my answer very quickly. I think you're absolutely right. But I also think that in every generation, something unprecedented happens. And we can go through a litany right now. And a lot of times, some things that look like they were helpful rules of thumb, they have to be thrown out because the world changes. And that may be the case here. But I think one very key part of my investment philosophy is that risk is rewarded. I think there's a link between the two. I don't think you can have the reward without taking risk. And I think some risk is necessary. And intelligent risk will always pay a reward. You just might not love the time horizon that you have to wait in order to receive that reward. So if you believe that, then I think a lot of the things that have changed become a little bit less important in your long-term calculations. Nina, how would you answer Sarah's question?
I'd piggyback on everything you said. I think we have to look back and say history doesn't necessarily repeat itself, but the markets have come back, and we'll get through this using some of the investment fundamentals that we always have.
Yeah, impossible to actually time it. Josh, Nina, stick around, and thanks to everyone for their questions. We've got more of them, and we're going to take them next. We are taking your investment questions tonight. Our next one comes from Justin Brandt. Let's watch.
How much of your retirement portfolio should be in international funds? Or do large U.S. companies give you enough exposure?
Josh Brown, Nina O'Neill still with us. Josh, what do you say?
You know, this is such a great question, Justin, and it's at the heart of a debate that's been raging between some of the biggest heavyweights in asset management, portfolio theory. So Jack Bogle says none, or had been saying none prior to passing away a couple of years ago. And Bogle's argument was U.S. companies give you all the exposure to the rest of the world you could ever ask for. And there is some truth to that. A great deal of the S&P 500's earnings and profits come from overseas. However, there's another school of thought that says you're going to not just want exposure, but you actually want exposure to the cash flows themselves. And owning stocks gives you that risk and reward that moves assets up and down. And international stocks in some markets will be non-correlated to U.S. stocks. The best example of that is from 2000 to 2009. U.S. large cap stocks had a lost decade, 0% returns. And if you factor in inflation, you actually lost some money. International stocks, in the meantime, had a very decent decade and made you some money if you were invested throughout, especially if you're in emerging markets. So I don't think it's a yes or no answer. I think it's philosophical. For our clients, however, we do believe that international stocks play a role in a portfolio, and we always keep them at least the global market cap weight, if not overweight in some environments.
All right, Josh, Nina, stay with us. We've got a lot more questions from everyone out there to come. But first, more than 22 million Americans are currently collecting unemployment benefits. But many Americans may not realize that compensation does not come for free. CNBC senior personal finance correspondent Sharon Epperson has more. Sharon.
Sarah, you know, if you lost your job, you could see a significant drop in your income this year. But if you're getting unemployment benefits, you could still have to pay a tax bill next year. Your state's unemployment benefits, as well as the extra $600 a week that you will be getting in coronavirus relief from the federal government, it's all taxed as ordinary income, just like wages. While you don't have to pay Social Security or Medicare taxes, your unemployment benefits will be taxed by the federal government and possibly your state. And if you don't pay enough tax, you may owe penalties and interest as well. So here's what you need to do to avoid getting that tax hit. You could ask to have 10% of your unemployment benefits withheld to pay taxes to the federal government. You could also pay estimated taxes every quarter, or you could save 10% of your unemployment benefit payments to put towards savings for a worst case scenario, another worst case scenario, or down the road to pay your taxes if you owe them. Ken Lin, who is the CEO of Credit Karma, was telling us they offer a free online tax preparation service, that this saving the 10% really makes sense to provide yourself with this cushion and some flexibility to deal with bills that you may have to get paid over the course of the year. And then if you don't need to spend that money, you do have that savings that you can put toward a potential tax bill in April. If you've already applied for benefits, you didn't know anything about this, or you're receiving benefits, you didn't know anything about this, you can fill out an IRS form W4V, which is for voluntary benefits, and you can change your withholding. But you want to make sure you do it correctly. So go to careeronestop.org, find the link to your state's unemployment insurance program, and make sure you follow the details there to cover yourself for not having a potential tax hit next year. Sarah?
It's really surprising, actually, to find that out, Sharon. Meantime, this past tax day has been postponed from April till the summer. What else do we need to know about that, and how people should be getting ready, given there's so much pain and still so much uncertainty out there about when economies are going to reopen and when we can actually get government functions like the IRS working?
Well, you want to make sure that you don't pay to have your taxes done if you can help it. And so going to the IRS website, irs.gov, and finding out about the free file program and what online companies are working with them to help you do your taxes, that's a first step. And of course, you want to make sure you have all the documentation that you can so you don't miss out on important deductions, important credits like the earned income tax credit, a lot of the child care tax credit. There are a lot of tax credits out there, again, giving you a dollar for dollar savings on your taxes that you want to make sure that you look out for and you don't want to miss. And going to irs.gov is probably the best place to find out what you need to know.
Sharon Epperson. Sharon, thank you. Let's get back to your questions now and investment advice. Josh Brown, take it away.
Yeah, I've got a good one on real estate. This one comes from Greg Garcia in California. Thank you, Greg. How important a role does real estate play in one's overall portfolio? What percent do you advise for someone in that 40-plus age bracket? If you're a homeowner, do you include that as part of the allocation mix? If not, do you advise rental properties, or can you satisfy the investment via REITs or other instruments such as owning trust deeds? Greg, I feel like you snuck in 9 or 10 questions there, but I'm going to try to answer this as succinctly as possible. I would not look at your own home as though it's a real estate investment. A house or an apartment, somewhere that you live, your primary residence, is actually a form of consumption. Whether or not you're renting it or you own it, it's both the same thing. On a national basis, over decades and decades, on average, home prices appreciate 1 or 2% a year, basically in line with inflation. In some neighborhoods, you get really lucky. In others, you don't. I wouldn't look at that as part of your portfolio at all. REITs are great. You know what the good thing about a REIT is, as opposed to becoming a landlord in your spare time? The REIT is never going to call you at 1 a.m. and tell you the refrigerator's broken or the sink is running. So I would think about something like VNQ, which Vanguard puts out. It's an index with REITs in it. If you want to get fancy and more specific, there are REITs for every single type of real estate out there. Nina, how do you answer that question about the primary residence being an investment or not?
Oh, you're dead on. I mean, I think in the housing bubble, we really saw that that was not the right philosophy, particularly short term as your home as an investment. We look at it as just it's the place where you live. Maybe over time, it could be something that adds value to your total net worth, but it's not something we're banking on. If we're really looking at investing in real estate, we're talking about REITs, a rental property or an investment property. And I loved what you said about, I've been a landlord and you do get the calls. So a REIT is a way to get into an allocation without having the heavy lifting of actually owning the properties. And sometimes you can get into that in a lot less money as well versus the upfront capital of having to put down payments and then also dealing with tenants or even property management companies. So I'm 100% with you on that. And I don't really have an allocation percentage recommendation. I think that's per person and comfort. But I do think real estate is an important part of an overall asset allocation for someone.
Yeah, it's a really great point about how you can own a lot of properties with a small amount of money through REITs. You don't have to have $1 million to start investing in real estate. Also important to point out, the S&P 500 incorporates real estate. It's the 11th sector of that average. So you're getting exposure, whether you know it or not, with a broad, diversified portfolio. Let's get to Marty Lindgren in Calgary. Love Calgary. Josh, the bond market makes my head spin. When rates were going down, I was in 30% VCSH, which is a corporate bond ETF, and it did okay. All of a sudden, TLT was the go-to bond fund. With the volatility, I ditched bonds. Now I'm 25 to 30% cash, giving me versatility to pick up assets. Okay, so a couple of things are going on here. Marty, it sounds like you don't really have a strategy. It sounds like you're sort of market timing, and the bond holdings that you're discussing are all over the map. So when you think about TLT, I want you to think about that as being the most volatile possible way to own treasuries. It is not the same as owning a 3-year, a 7-year, or even a 10-year treasury, and it's definitely not the same as cash. When interest rates move, TLT is going to move a lot. It's almost going to look stock-like in certain market environments. So that is an instrument that a lot of traders use. I wouldn't look at that as an investment. As far as the portion of cash, it sounds a little bit like market timing, and I'm not going to try to talk you out of it, but that is definitely not a long-term strategy and part of a long-term portfolio.
Josh, my question is about bonds. I know they're important for your portfolio to diversify, but I don't feel like I understand them very well. Is now a good time to be adding to a bond fund, or should we wait? And if we wait, what are the signals to look for?
That's Marty Conway. Josh, what do you tell Marty?
That's a really great question from Marty. I think the important thing, the most important thing I can say to answer that question right now for everyone listening and paying attention, there are 2 reasons to own bonds. The first reason is current income. That reason has been taken away from us by economic circumstances that have dropped income levels for bonds across the entire chain of fixed income. The Fed is doing that deliberately to foster liquidity and give people the appetite to take risk. We won't debate whether they should or shouldn't. That's the reality. So what's the second reason? Why should Marty Conway have bonds? Bonds, high-quality bonds like investment-grade corporates, but more importantly, treasuries, tend to act as a stabilizer in a portfolio in times of market volatility. You will frequently find situations where stocks are falling, but high-quality bonds are rising. That's people moving money away from risk toward perceived safety. And that is why you want to own bonds, because when the damage is done in stocks, you then have an asset that's appreciated in value. You can sell that asset and you can add to equities at lower prices. Okay, let's get into question 8. This is Dan Cohen from Long Island. I'm from Long Island too. I don't know if you could tell by my accent. Dan says, I'm 23 and I make less than $70,000 working for a publicly traded company. I've been investing in stocks instead of using a Roth IRA or my company's employee stock option purchase plan. Is this an advisable route? And would you advise staying away from a volatile environment like the current one? I'm going to give you a quick answer, and I want to hear from Nina on this. I would say the absolute best thing you could take advantage of is anything that the corporation is offering in terms of a 401k or tax-deferred way to put income away. The Roth is killer. If you're 23 years old, Dan, you're probably never going to make as little money as you're making right now, which means you pay the taxes on it, which are low, put that money away, and 40 years from now, you'll be taking that money out tax-free, presumably when you're in a higher tax bracket. So I would take advantage of both of those things. I would not worry about volatility at all. As a 23-year-old, volatility is your friend. It is the source of future returns. Nina, what would you say to Dan Cohen?
Oh, 100%. Dan, I love that your mind is in the right place, thinking about investments and your long-term future so young. But and Dan mentioned stocks versus Roth IRA and the ESPP program, which is your employer employee stock purchase program. I don't think it has to be either or. He can invest in stocks within his Roth IRA and get that tax-free growth, and then ideally over time let that grow and come out tax-free in retirement or in later years. But also the ESPP program is a great way to access discounted pricing for a company stock that could appreciate over time as well. So I think that it doesn't have to be an either or. I think really looking at, Dan, looking at your cash flow, seeing what excess cash flow you have, and making sure you're taking advantage of, as Josh said, corporate returns and anything else that you can use for long-term savings.
Okay, let's get into question 10. I think this will be the last one, and it's a good one to end on. Tristan Irwin from Toronto asks, you mentioned in your lifetime you expect to see the Dow at 100,000. As an investor with a similar time horizon, 30 or 40 years before I need to touch my investments, should I ignore news headlines, put extra money into the market, regardless of valuations? All right, so let's take out the regardless of valuations, because if I say yes, everyone will say, what about Japan, which historically has not seen the same peak that it had in the early 1990s. The U.S. stock market should hit 100,000 points, the Dow, within my lifetime. That's very reasonable using a 7% average annual rate of return going forward a few decades. But there's going to be a lot of negative news along the way. There's going to be a lot of volatility along the way. So I think when you're allocating with that time horizon in mind, the best possible way you could do it is in an IRA, a 401k, where literally you get penalized for reaching in there and trying to grab the money out. I think setting your rules when you allocate, deciding how much of each paycheck is going into the stock market, and then not changing that based on your feelings is going to be way more powerful than anything you could do in terms of trying to outsmart the market or trying to react to a particular news story or headline. So keep in mind the length of your time horizon, and Tristan, keep going. Sarah, back to you.
That was great. Josh Brown, Nina O'Neill, thank you both. And thanks to everyone who wrote in and sent their questions, especially those by video. And don't go anywhere. Another CNBC special report is coming your way. Markets in Turmoil is next.